to Blind Squirrel Macro, the pod. This is our usual companion to our weekly newsletter. This week, tape bomb refuges. Now, I'm coming to you on the morning of Monday, the 27th of January, Melbourne time. Quick reminder to make sure that you get the show notes for charts and links, plenty in there this week, and if you don't have them now, fix that right away by signing up for free at blindsquirrelmacro.com. First up, everything in this podcast is for educational and entertainment purposes only and is categorically not investment advice. Before making any investment decisions, for heaven's sakes, don't listen to a cartoon rodent talk to a financial advisor. Now let's start with a squirrel dictionary definition. Tape bomb, noun. A presidential proclamation, on or offline, that sends markets into a tailspin, aka tweet tremor, or digital detonation. Now, it's been less than a week since the inauguration of Trump, and the tape bombs have been raining down hard. Last weekend, the squirrel suggested that commodity and FX traders might want to lock away their buy and sell buttons in the desk drawer for a few days. With hindsight, that counsel is aging pretty well. Last Monday saw currency traders rush to cover short positions in Canadian dollars and Mexican pesos on the revelation that the initial batch of executive orders contained no specificity at all in relation to tariffs on the US's northern and southern neighbours, only to get rug pulled faster than a meme coin trader by some off-the-cuff statements from an impromptu Trump press conference later on in the day. Fun times in FX land. When it came to China, the initial trade war vibes appear softer than could have possibly been envisaged during the heat of campaign rhetoric. 60%! Immediately! Then Trump gives an interview saying that he'd rather not put them on at all. Cue a manic scrambling by traders to cover shorts in the Aussie dollar. AUD/USD up a full big figure, as they say in FX land over the week. That's 1.7% in real numbers. Of course, we all know that this isn't the end of the tale. Just look at the Colombia news overnight. Those with distant memories of the markets of 2018 and 2019 should remind themselves of the volatility that can come to asset markets once tit-for-tat trade measures start hitting the tape on a monthly basis. I've included a Goldman chart in the notes that makes it pretty clear that tariff headlines can make for a hairy backdrop for risk. As they say, nobody wins in trade wars. Well, perhaps nobody was a bit too much hyperbole from the squirrel. The sound of traders clicking buy and sell buttons like one of Dr. John C. Lilly's monkeys, look it up, in response to each trade-related tweet and utterance is music to the ears of the owners of the world's largest financial exchanges. Could exchanges be a refuge from the tape bombs? Now, the greatest gift to them is investor repositioning, and even without the trade war speculation, we're already living in a world of constantly seesawing macroeconomic narratives. The past 2 years has seen interest rate markets reprice the odds of a recession in the US just about every 6 months. Equity markets have similarly seen some violent narrative shifts in recent months, giving rise to some extreme factor rotations. Also, significant shifts in investor sentiment are the ever-present driver of financial transaction volumes. Now, the squirrel doesn't want to enter into the hotly contested debate as to whether or not tariffs are inflationary in their own right, or instead just a one-off sales tax that creates higher prices. I say tomato, tomato. But surely these price hikes mess with that all-important psychological input, inflation expectations. That hot debate aside, your macro rodent is sticking with his core view that we could be looking to enter a period of inflation volatility, albeit with a lower floor to the lower bound of inflation, that could mimic the macro conditions in place when this rodent was wearing short trousers. What if we were to repeat that period of inflation volatility seen between the late 1960s and the early 1980s? Inflation volatility requires more frequent portfolio repositioning. This leads to increased trading volumes in financial assets, leading to higher transaction fees and revenues for exchanges, with negligible increases in their fixed costs. Exchanges typically enjoy strong pricing power that allows them to raise fees to keep pace with any inflation. Liquidity in any financial asset tends to be dominated by a single trading venue. For example, dual listings of equities tend to be implemented for market access, political or governance reasons only. Trading volume always gravitates to one place, where the spreads are tightest. This effect creates almost impenetrable moats for most exchanges. Market participants are always keen to try and foment competition in the market, in the market for financial asset market squares, in the hope of lowering transaction costs and fees. FMX's chairman, Howard Lutnick, the new Secretary for Commerce, is no doubt very well positioned indeed politically, but will it be sufficient to break the CME's stranglehold on US Treasury and SOFR futures volumes? History suggests that this is unlikely. Here is Mike Dennis, CME's global head of fixed income, discussing the new competition from FMX in SOFR futures late last year. It's still early days, but we see our bid-ask spreads are a quarter tick tighter in the front month SOFR contracts and almost a half tick tighter as you move out the curve. As we know, a half tick equates to $12.50 per contract in SOFR futures, which dwarfs the size of the transaction fee. Squirrel note, this fee is currently $1.25, so $1.25 per side per contract, so a tenth of the overall spread value being mentioned there. You can, however, understand why Mr. Lutnick thinks that he might have a chance. Exchange monopolies have been successfully broken before. Look no further than the New York Stock Exchange's loss of US equity dominance with its effectively forced demutualization and merger with Goldman Sachs's Archipelago 20 years ago. This merger created the NYSE Group, now a subsidiary of ICE, not that one, the Intercontinental Exchange. Then there's order matching technology such as dark pools, electronic communication networks, ECNs, or alternative trading systems, ATSs, that have enabled the largest customers, with the help of powerful lobby groups, to force changes when they consider the rents to be too high. These days, US equities have over a dozen separate trading venues, frankly just usually a rack of servers in New Jersey. In response to the assault on their core revenue source, i.e. the business of clipping tolls from trade execution, the exchanges have innovated. The modern battle lines of competition revolve around pricey data, new product creation, connectivity, and some other services. 2 decades on from the disruption in the early 2000s, the major global exchanges have diversified themselves significantly from simple rent collection, adding numerous and high-margin lines of business. I put an infographic on that in the notes. Now, I can't tell you how many times in the past couple of years that I've seen charts showing the dominance of US equities as a share of global listed equities. With a market share greater than 70% today, versus 24% of global GDP and only 4.2% of global population, it would make sense for any investment in financial exchanges to give thought to international exposure in the mix. With only a couple of exceptions, global exchanges have been pretty decent investments over the past 5 years. Not Nvidia big, but pretty constructive nonetheless. I've all set this out in the note. Hint, hint, I think this can be sustained. Unsurprisingly, in an increasingly financialized world, exchanges have grown and are expected to grow revenues at rates considerably ahead of GDP, while delivering impressive cash flow margins and solid double-digit ROIC, or returns on invested capital. With those market and returns profiles, the exchanges still command undemanding, in my view, valuation multiples. Meanwhile, the investment focus of the compounder bros has been commanded by software as a service and payments giants on significantly elevated multiples. The Squirrel thinks that mid to high teens forward EV to EBITDA multiples for the exchanges, basically in line with the S&P 500, compare very favorably with where the market currently values those traditional compounders. Incidentally, the elevated EV to sales multiple of the exchanges does not worry me that much at all. The group's average gross margin is over 90%. I think exchanges are worthy of a place in the portfolio. In section 2 of the written note this week, the Squirrel laid out how these quasi-monopolists might fit in. We also provided some updates on the Bushy and Acorn portfolios. Check it all out at blindsquirrelmacro.com. You can also find me on Twitter at squirrelmacro and on Blue Sky at blindsquirrel. Thanks again for listening. Please do spread the word and please rate the pod. Squirrel out.